The barrier has finally been broken. For months, the entire financial system repeated the same message. We were told that $65 was the absolute limit. We were told it was the final ceiling. We were told the banks would protect that level at all costs, using paper contracts and financial pressure. But today, Wednesday, December 17th, the market made its own decision, and it made it forcefully. Silver did not just touch $65, it pushed straight through it. Earlier today, silver surged to $66.50. As I speak right now, the price has pulled back slightly and is sitting around $65.80. I know exactly what many of you are feeling. You see the price move down from $66.50 to $65.80 and doubt starts to creep in. You start asking yourself, was that the top? Was this another false breakout? Is the move already over? Pause right there and listen carefully. What we are seeing is not a collapse. It is not a failure. It is one of the strongest and healthiest behaviors any market can show. This is known as a retest. In this deep market update, we are going to break down exactly how this breakout happened. We will explain why silver jumped to $66.50 so quickly. We will expose the gamma squeeze that forced banks to buy against their own positions. And most importantly, you will understand why the pullback to $65.80 is actually a positive development. If silver had continued straight upward without stopping, the move would have been unstable and dangerous. Markets need pauses to build strength. This pullback is not weakness, it is the market testing the ground beneath it. The wall at $65 has been destroyed. Now the market must stand on the rubble and prove it can hold. This is the real story of the breakout. To understand why silver jumped from $64 to $66.50 this morning, you need to understand how the market actually works beneath the surface. Specifically, you need to understand gamma. Gamma is an options trading term. It measures how quickly a market maker's risk changes as the price moves. Think of the market maker as the casino. They sold millions of ounces worth of call options at the $65 strike. These options are bets that silver will rise. As long as silver stayed below $65, those bets expired worthless. The banks collected premiums and stayed safe. But the moment silver crossed $65.10, everything flipped. Once the price reached $65.50, the risk inside the bank systems exploded. The computers detected massive exposure. To protect themselves from catastrophic losses, the systems automatically began buying silver futures, not because they wanted silver, but because they had no choice. That buying pushed the price to $65.30. That increase raised their risk even further, forcing the system to buy even more. That wave pushed silver towards $66. This is the gamma squeeze. It is a self-reinforcing loop. Forced buying creates higher prices, which creates more forced buying. This exact mechanism is what sent GameStop to $400 in 2021. It has nothing to do with fundamentals or supply stories. It is pure mathematics. This morning, that math overwhelmed the banks. The spike to $66.50 was not organic enthusiasm, it was algorithmic panic. There were almost no sellers, only machines trying desperately to reduce exposure. So why did the price stop? Why did it fall back to $65.80? Because humans stepped in. Traders saw the vertical move and locked in profits. The forced gamma buying ran out of fuel. The market returned to balance, but the damage was already done. The $65 level had been destroyed. Now the market must stand on the rubble and prove it can hold. Let's talk about where we are now. $65.80. To inexperienced traders, a drop from $66.50 to $65.80 looks like weakness. To professionals, it looks like confirmation. There's a core rule in technical analysis. Old resistance becomes new support. For months, $65 was a solid roof. Every time silver reached it, the price collapsed. Today, that roof was smashed. Now the market is standing on top of it, testing whether it can hold. This pullback to $65.80 is that test. If buyers step in here and the price stays above $65 through the daily close, the breakout is confirmed. That tells the market that $65 is no longer a selling level, it is now a buying level. But this is where caution matters. If silver falls back below $65 and closes the day at $64, that would be a failed breakout. Failed breakouts often lead to sharp declines. That is why 65.80 is critical territory. It is the battleground. We currently have 80 cents of room above danger. This is not the moment to celebrate. This is the moment to watch the close. Now let's talk about the whale. Remember the massive buyer who absorbed $650 million worth of silver at $63? People asked if they sold at $66.50. I've been watching the order book closely, and I can tell you this, the whale is still active. When silver dropped from $66.50 to $65.80, huge buy orders appeared around $65.75. Someone stepped in and said, "I will buy everything you're selling." That tells us something important. Last week, smart money thought $63 was cheap. Today, they believe $65 is cheap. They are defending the breakout. This is not how short-term traders behave. Traders sell strength. This buyer is supporting weakness. They are building a floor under the market to prevent a breakdown below $65. Why? Because they understand what happens next. If $65 holds, the next target is not 66, it is 70, then 85. This is accumulation, not distribution. So when you see 65.80, do not think of loss. Think of consolidation. Think of large players reloading before the next move. The gamma squeeze was the spark. The retest is the fuel. But the real fire comes from the short sellers. For decades, commercial banks like JP Morgan and Bank of America have held massive short positions in silver. They sold paper contracts to suppress the price. But at $66.50, those positions became disastrous. In Part 2, we examined reports that a major commercial bank began closing its short position this morning. We explained why short covering acts like rocket fuel, and we calculated the damage. According to the Commitment of Traders report, commercial banks are short roughly 80,000 contracts. One contract equals 5,000 ounces. That equals 400 million ounces of silver sold on paper. They sold it at $50. They sold it at $55. Today, silver trades at $65.80. Every single contract is underwater. When you are long, your maximum loss is zero. When you are short, your loss has no limit. If silver goes to $100 or $500, the bank owes that difference. At $66.50, risk managers realized the losses exceeded quarterly profits. This forced a shift in behavior. Instead of adding shorts, they began closing them. Closing a short means buying. That buying creates a permanent bid under the market. This is why 65.80 is holding. The banks are slowly eating their own exposure.
Let's quantify the pain. For every $1 move higher in silver, commercial shorts lose roughly $400 million. Silver moved nearly $6 from $60. That equals $2.4 billion in losses. And that assumes they can exit at current prices, which they cannot. Trying to buy back 400 million ounces would send prices far higher due to slippage. This is why $65 was the Maginot Line. Above this level, losses become visible. Regulators ask questions. Shareholders panic. The banks are wounded. They may attempt one last overnight paper dump to scare the market. If silver briefly drops to $64, do not assume failure. Unless we break below $61.50, the trend remains intact. Capitulation is a process. While the banks fight on paper, the physical market tells a different story. Industrial users are paying $70 or more per ounce just to secure metal. Electronics firms are bypassing exchanges and going directly to refiners. Premiums are rising even as spot consolidates. Retail dealers are widening spreads. Coins priced at $65 now cost $75 or $80. Pre-orders are common. This means inventory is tight. If you see 65.80 on a screen, understand this: you cannot buy physical silver at that price. The system is straining. Paper holders face another risk: cash settlement. If banks cannot deliver metal, contracts can be settled in cash. If that happens, confidence collapses and physical demand explodes. This is the feedback loop beginning. Now comes the psychological test. Volatility will increase. Price swings will grow violent. This is designed to exhaust weak hands. Do not watch the 1-minute chart. Look at the weekly trend. Silver is not expensive. In 1980, silver hit $50. Adjusted for inflation, that equals roughly $170 today. At $65, silver trades at a massive discount. Stocks are expensive. Real estate is expensive. Silver is not. When it is time to exit, you do not sell for cash, you swap. Watch the gold to silver ratio. When it compresses, you trade silver for gold, land, or productive assets. This is how wealth transfers are locked in. Wednesday, December 17, 2025, will be remembered as the turning point. The $65 wall fell. Control was lost. Price discovery has begun. You are already positioned. Do not panic, do not sell. Let the market come to you. The squeeze has only just started. Hold fast. Subscribe.